Well, good afternoon, everyone. I'm Travis Ehlen, the Director of Wealth Management with Ehlen Heldman. I want to thank everyone for joining us today. We've got a great speaker, Peter Walker with RNC Genter, that's going to be leading a discussion about the macroeconomic trends that's going on in the world. We've got definitely some interesting times that's taking place right now, and the world's changing rapidly. We've been working with Peter and RNC Genter for about a decade now. He's the Senior Vice President and Director of the Northern Region of RNC Genter. He's got over 20 years of industry sales and sales management experience. He has a Bachelor of Arts from the University of Vermont, is a certified investment management analyst, an accredited investment fiduciary, a chartered alternative investment analyst. That's a lot of alphabet soup there. And he's going to be leading the discussion. It should be about 20 minutes in total. We are recording the session. It will be found on the Ehlen Heldman YouTube channel. Securities are offered through Avantax Investment Services, member FINRA SIPC. Investment advisory services are offered through Avantax Advisory Services. Insurance services are offered through Avantax affiliated insurance agency. This content is for educational information purposes only and does not represent the views and opinions of Avantax Wealth Management or its subsidiaries. So I think I've gotten through all the disclosures today. With no further ado, I'll turn this over to Peter Walker.
Great. Well, thank you, Travis, and thank you all for joining me. Certainly do appreciate your time, and under the circumstances, obviously an interesting environment we find ourselves in. Travis and I were chatting a few moments ago and reminded of the quote from Confucius, may you live in interesting times. And I think this certainly qualifies in a lot of respects. And so, thoughts and prayers of those on the front lines in terms of what they're all dealing with in Russia and Ukraine. So with that, I do have a presentation here I wanted to share with you all if I could. If I can pull that up. Hopefully you all can see that presentation on your screens. And we'll run through a few of these slides here today. Did just want to give you a little bit of background in terms of RNC Genter, just so you have a better understanding in terms of our overall thought process. You can see the palm trees on the cover slide here. We are based in Los Angeles, California, actually in Hollywood, and actually frames a lot of the way we manage client portfolios today, in the sense that now over 50 years in existence, many of our initial clients were a lot of, and I use this term loosely, Hollywood elite, if you will. Folks in front of and behind the camera, people that may have signed a long-term or signed a pilot deal or sold a script or something to that effect, but didn't have that income stream ongoing. It was certainly less than certain. And so we've been tasked with creating high quality, conservative, relative value, but income-oriented strategies. And we're a true boutique, just over $6 billion in assets. You can see a sort of timeline of our history there on the screen. We're headed up by Dan Genter, who's of RNC Genter fame, so to speak. But he is a regular panelist on, you may have seen him on Fox or CNBC or CNN, or quoted in the Journal, things along those lines. And he does head up our overall investment committee, which is a group of our overall portfolio managers in terms of constructing our portfolios. Of the just over $6 billion, we do have, as I mentioned, really conservative income-oriented approach. So whether that's municipal fixed income, taxable quality fixed income, and our taxable quality intermediate strategy there has really become our flagship on the fixed income side of things. And then dividend paying equities as well, again, having that income focus. And so both sides of the ledger in terms of fixed income and equities, not only from a diversification standpoint for our business, but actually looking back the past 100 years. And you can certainly think of this in terms of your own portfolio, perhaps if you're diversified across different asset classes. There's only been 4 years in the past 100 that where both equities and fixed income were negative in the same year. So it was 1931, 1941, 1969, and then more recently in 2018. I say that because we are actually here negative on both fronts here today. That said, still have quite a bit of year left, and with that, did want to transition into really the main tenets of our discussion in terms of the market. And so obviously to do that, it's oftentimes helpful to just take a quick view back in terms of where we've been, and just in the more recent history, if you will. Just looking back even the past 2 years, almost 2 years to the day, and this chart on the left-hand side, what you can see is that COVID shutdown and the impact that had on the market. A pretty precipitous sell-off, not too dissimilar to maybe perhaps what we're going through again here, but that was really pretty short-lived, largely given the monetary and fiscal stimulus, the Federal Reserve in particular stepping in to really shore up the economy and instill confidence in the consumer and in employers largely. And we can see the yellow bar, which is the NASDAQ, more of your technology-driven companies. You can see actually, and then the green bar is the S&P 500. And the S&P less than 8 months later, again, because of those the measures taken by the Federal Reserve specifically, within 8 months was already back to an all-time high. And so, when we have sort of market gyrations and then the market shoots up, oftentimes people can forget how painful those periods can be. Although one reminder is that corrections, and just as of yesterday, we hit the correction territory for the S&P 500, which is a decline of 10% or more, and then a bear market being a 20% decline. And there's actually been 33 corrections dating back since 1980, averaging of about a 19% decline. All but 3 of those occasions, 1 year later, the market was higher, on average about 25%. So as painful as these periods can be, they do oftentimes create some opportunity, and opportunity, because of oftentimes what's led the downfall to begin with. So on the second slide here, what you can see is going back to the financial crisis. I'm sorry, the dot-com crisis in 99, 2000. We saw really narrow leadership where just a handful of companies, in this case 5, really accounted for much of the return. And had you not been invested in any of those 5 companies, your returns were significantly diminished. Yes.
Let me stop you for a second. I'm being told that no one can see the slides right now.
No.
I can share them on my screen if you want me to.
Sure. Let me see. Let me see if I can correct that.
And let me see if that helps.
Is that any better?
Well, I can turn mine off and you tell me, are you sharing them on your side?
No, I guess not if you can't see it.
Okay. So
I can try again.
If you're not able to, I'll put them up on my side and yep, there we go. I can see.
There we go. Okay. You can see the full screen. It's not just a smaller.
Correct.
Okay.
Yep.
So I apologize for that. We can just skip forward here again. So these will be just our firm background slides. You can see our firm history, and I can certainly forward these to Travis should any of you want a copy of the presentation deck. So this was the two slides that I had left on. So this illustrates the sell-off that we saw back in February 2020, and then the recovery and the sort of resulting due to the Fed impact, and then just the overall concentration of the narrow leadership that was led to that concentration, similar to the dot-com bubble bursting, where you had 5 stocks accounting for a disproportionate amount of the overall weighting to the index. Same thing could be said for, again, 5 different names in this case, actually one overlapping, that being Microsoft, which has led to really outstretched valuations. And so, the history doesn't often repeat itself, but it does rhyme. So we're certainly seeing, as we did in 2000, that very narrow leadership, which that has led to stretched valuations. As a further example of that across various markets, whether this illustrating the small companies, which is the Russell 2000, as well as for the S&P 500, the 500 largest names here domestically, as well as the NASDAQ, which is more of your technology-laden names. And you can see that overall market breadth has really deteriorated as the market has gotten more and more focused at the top. And so that's really led to sort of this dichotomy between growth stocks as well as value stocks. And in particular, you can see just how big that gap has been, really exceeding periods that we saw back in 2008, as well as 2000. So really at the extreme levels here. And as you can see, this did start to turn back here, and it's actually contracted here even more dramatically. So again, these are more of your growth dominated names that have really carried the day for the past 7+ years. We are certainly seeing more of a style change as the volatility has increased. There's been more of a flight to quality. So even though we've seen, broadly speaking, the level of companies continuing to beat from an earnings perspective, the market is really forward-looking, and it's actually the first time since the COVID drawdown that we are seeing guidance really turn negative. So on the left-hand side here, you can see the red bar being our most recent quarter versus the third quarter, and broken down by sector. So really, even more your more growth-driven sectors, so technology reporting more negative guidance, for example. Same thing can be said for industrials, as well as consumer services. Again, really more your growth names, where those negative guidance have really picked up rather dramatically. And then compare and contrast that with positive guidance going forward, whereas more of your value-driven names, so healthcare, financials, energy, have that higher forward-looking guidance. In terms of obviously switching to the fixed income side of things, what you have here on the left-hand side is looking at, obviously interest rates have been extremely low, and so what you have here, that orange line is the nominal yield. So this was as of end of the third quarter. We're at 1.3. We're now closer to 2%, just under 2% for the 10-year Treasury. And then you have your inflation break even, which is quite a bit higher, and higher still now, where we fall. And then so basically your inflation break even minus your nominal yield is your real yield, your yield net of inflation. So really, there's just the tremendous erosion of purchasing power that inflation can have. And with the consumer price index that it's recently come out, that it's 7.5%. While the Federal Reserve really targets more the PCE core number, that headline number is more widely followed. And initially, like most in the market, really did believe that the Fed was pricing in a 50 basis point interest rate hike here in March. They had been very open in terms of being trying to telegraph things and reiterating how it is important to be data dependent. And now with greater uncertainty around the world, wouldn't be surprised to see, and I've already seen talk in terms of the Fed downplaying a lot of that. Initially, at least seven rate hikes were priced in here in the market, and obviously things continue to change pretty dramatically in a very rapid environment. And really, the Fed has two main policy goals this year, and to really to get that PCE core number in that 2% zone, as well as really trying to avoid overly flattening the yield curve, specifically between the 2 and the 10-year part of the Treasury curve, because really don't want to stem off the economic growth that we do have. And then so on the right-hand side, what you can see here is those real yields, more up to date, really in that minus 3% range here. So what have a lot of companies and consumers been doing, and a lot of it, some people have been anticipating some of the impact and have been really compiling cash. So non-financial corporations have 6.5% of their assets in cash. It's up from 4.5% in pre-pandemic levels. And then the long run average, you can see it at 3.8%. So really trying to insulate balance sheets to a large degree. Other macroeconomic drivers, I mean, it's not certainly all negative by any stretch. There are, and any disjointed market moves create tremendous opportunities. Certainly, household net worth is up tremendously, up 21% since the end of 2019. Consumers are net savers, even though you're really not getting paid to save money, again, just due to that the impacts that inflation can certainly have. But consumer makes up 2/3 of our economy. So to the extent that the consumer is strong, our overall economy traditionally follows suit. Bank lending standards are certainly very accommodative. And so there is still significant amount of cheap money out there, in addition to bank deposits, which banks lend off of. Commercial banks, 16.6 trillion, which is up 3 trillion since 2019. You can see the moving average line in there, so certainly well above trend. And a lot of that is geared off of what you can see on this slide here. And so this blue line are your bank deposits. And really, they are the grease that makes the loans and the businesses to individuals. And the green line is the actual loans themselves. And you can see it really decoupled during the financial crisis. And then the red line is the Fed balance sheet, which is now $9 trillion, and really just beginning to taper that back. Although really hard to put that toothpaste back in the tube. You can see in 08 that big spike up in terms of that monetary and fiscal stimulus, and then more recently in COVID, the other big spike up. So that divergence between that blue line and the green line should certainly narrow. Yields should naturally rise as excess liquidity plateaus and eventually starts declining. This should lead to lower inflation pressure on goods and services. Obviously, inflation is still a tremendous concern, but the bigger concern is on the impact on asset prices, and which have really been the primary beneficiary of excess liquidity back for the past decade. So other reasons, for optimism. I mean, really depending on what side of you're an employer or an employee. Obviously, there's still a tremendous amount of job openings. So this blue line is the job opening and labor turnover survey, JOLTS report. So at 11 million job openings, and we're still about 3.5 million below where we were pre-pandemic level in terms of overall employment. So again, as people's savings have dwindled and the stimulus has dried up, more and more people are re-entering the workforce, which again, continued driver for the economy going forward. And then really inventories have been really picked bare, with large part due to supply crunches, which really do see, well, prior to the most recent saber rattling and things along those lines, did see some nice loosening of some supply chain issues, but manufacturing is up and trending in the right direction. Obviously, a lot of these things, as always, can certainly take one step forward and two steps back, or vice versa. And then finally, just in recap here, reasons to be optimistic in terms of the overall market currently, continued improvement in the labor market, healthy consumer spending, albeit on different things that we've seen over the past 18 months. Strong demand from businesses to rebuild inventories and invest in capital upgrades, many of which are long overdue. And the U.S. economy, which is ready to run on its own power, which is really the primary reason the Fed is looking, or one of the main reasons the Fed is looking to raise interest rates here, because the economy is ready to run on its own, under its own steam. And then the global growth certainly has been more synchronized here, as the overall global economy continues to gain traction. The business fundamentals in the U.S. Still have a line of sight above that growth line, and central bank policies again still very accommodative, and pumping in a tremendous amount of liquidity. And then inflation, it is certainly high. There is reason to be optimistic in terms of, even though the Fed has removed the transitory talk in terms of inflation, but a number of measures, technology being one of them, which could certainly help to assuage inflation risks going forward. And then finally, in terms of real rates being negative, again, it does create certain pockets of opportunities, select, whether it's dividend paying equities or opportunities across the yield curve as we have more disjointed movements across the curve, whether that's through treasuries and or corporate bonds. So I think that pretty much takes us up to the allotted time, but Travis, I turn it over to you if you have any other comments or things along those lines.
Yeah, a couple questions because I think you've painted a picture that moving forward, the oversized growth that we've seen the last 2 years with all of the stimulus and accommodative measures by the Fed, that we're expecting that to be reduced from these tremendous growth period that we've had. That being said, with the changing of the monetary policy that that's taking place, whether it's through the taper today and the many interest rate increases that are being priced into the market over this upcoming year, how are you positioning your fixed income strategy, and how can other fixed income investors position themselves to really put them to be in a good place for this upcoming year?
Yeah, so what we've done is really taken this opportunity to de-risk and even going into the rate hikes to really to shore up portfolios. So what we've done in two ways. One, we've shortened the portfolio duration, so bonds with shorter term to maturity, so to not have as much interest rate risk in the portfolio, and then increased overall credit quality of the underlying issues in client portfolios. So we now have a solid A+ credit rating in terms of the bonds in our most all of our client portfolios, and then but have that dry powder, if you will, whether that's cash. Oftentimes we will use treasuries as dry powder to take advantage of some of these opportunities. Again, whether it's across the curve or in higher yielding corporate bonds, bonds that we've done tremendous amount of credit work on to make sure we understand all of the risks associated with those higher yields. So, but the bigger danger is just reaching for yield for the sake of yield. Which we'd certainly caution against. Certainly, at least until there's additional visibility in the Fed direction and the global economic situation we're in.
That makes sense. And in the last 2 years, there's been a lot of people reaching for yield because there's been so little. People have taken a lot more risk than they realized, I think. So that makes a lot of sense of increased quality, shorten the duration. Now let's flip over to the equity side. How are you guys managing your dividend equity portfolio in light of the market correction that we've recently had, and then and all of it's just the change in the macroeconomic changes that we're seeing?
Yeah, actually, we've been a tremendous beneficiary just in terms of the way we're allocated, and not because the team is doing a tremendous job, but it's an area that's been, in thinking back to some of those slides, where it's been such a growth dominated market for the past, call it 7 years. These very narrow leadership, a lot of technology driven names, great companies, but just have been so bid up. Whereas historically there are just defined period cycles, 5 to 7 years, where one style will outperform, and we're arguably heading into a period, if history is any guide, where value could certainly be take the reins here. And so we're a high quality relative value approach, so these are your financials, your energy, which has been a beneficiary here of late, healthcare, specifically in the pharma space, but companies that pay a dividend and grow that dividend over time. So we have a very attractive dividend yield on that strategy, over 3%. Very recognizable names, the likes of Home Depot or J&J, a CVS. Some of these companies paid dividends for 75 years. And yeah, from a an overall return standpoint, I mentioned the S&P down over 11%. We're actually flat on the year.
Oh, wow.
So yeah, been able to navigate things quite well. I mean, that's obviously no guarantee going forward or
Sure.
anything to that effect. But the advantage of dividend paying stocks is that you do get paid to wait effectively.
Mhm.
And or you can certainly use that income to draw off of at any point as well.
Absolutely. Well, Peter, I want to thank you for coming on and sharing all that information. There's no question. This is the first time in several years we've had some immediate, well, since 2020, that drawdown we had in 2020, but and even before that, it had been a couple of years before that. So it's easy to get comfortable with constantly increasing markets and not anytime we have a drawdown, it makes people uncomfortable. But after seeing all the data that you presented there on what the future economy, assuming a soft landing by the Fed looks, I mean, it looks very accommodative. I mean, it looks like we should have a period of at least healthy growth moving forward once we get past this next period of time. Who knows how long that will be? I keep telling people, let's get through the next 4 months. Let's get to summer and see where we are in terms of monetary policy and see how that's going to impact us. But I appreciate you coming on today. I want to thank everyone for coming on today. I like to keep true to my time and saying 30 minutes on these sessions. We will be following up with everybody that was on the call today to answer any questions that you have, specifically related, any questions that you have, and then answer any questions about your particular situation, because I always stress with anyone talking about, oh my gosh, the market's declining, how does this impact me? Well, let's look at the details of what you have in your portfolio to really understand how it's going to impact you. Because how you're positioned and what you own can make a significant impact. Just as Peter was saying, their dividend strategy is flat on the year when the S&P 500 is down, 10 to 12% as of today. So knowing what you own and understanding the risk behind it are really important. So again, thank you for everybody coming on. Peter, we really appreciate it. If everyone has enjoyed this presentation, please let us know. Next month, we'll have Brant Owen, and he'll be on talking about Social Security and different claiming strategies and how the program works. So we'll have more information coming out about that here shortly. Other than that, again, I appreciate everybody, and we'll talk soon.
Thank you. Bye-bye.